Joining me is Devang Shah, who is co-head fixed income at Axis Mutual Fund. Thank you so much, Devang, for taking the time. First of all, what did you make of the Fed chair's statement? There seems to be a dwindling tribe of people that are saying that inflation is transitory. What are the implications for global bond yields then?
Right, so I think so. There are two aspects to it. I think somewhere down the line, though the Fed was more talking about a transitory inflation, if you actually look across at the markets for the last 2 months or so, global yields have started increasing, and the reason for them has been a couple of things. One is the higher prints on inflation. I think the opening up trade, because globally, I think this once the second wave, including India, the second wave settled down, the growth cycle is quite strong. Supply chain bottlenecks continues, and hence the inflation numbers are also higher than what market was expecting across the world. I think commodities is the third factor, which is actually leading to where we are seeing a significant spike in prices in commodities across metals, base metals, crude, everywhere. So combination of all the aspects, good growth, opening up trade, inflation, supply chain, as well as commodities, the yields started going up despite central bankers being slightly more dovish. The Fed, actually, before Fed, we also heard the US president talking about that somewhere down the line, the inflation doesn't seem to be transitory and it's a worry. And even the Fed governor changing his probably the stance led to flattening of the curve. I think the short end of the curve will sell off more, which has already, we have seen that, we have witnessed that. And it is not only US, I think across other markets, including India, the short end of the curve, the yields have started going up, because somewhere down the line, the markets have to start getting readjusted to the fact that the easy and accommodative stance cannot continue for perennial. It has to stop, and somewhere down the line, that will lead to the short end of the curve yields inching up. Our view is that does it lead to any significant change in the governors or Fed governors' guidance on rate hikes? My personal view is no. Probably we'll see a couple of rate hikes in calendar year 22. We don't pencil in anything more than that at this point of time. But the overall short end of the curve, which was pricing in a loose accommodative stance for long, I think that should get readjusted. They also spoke about taper being slightly faster than what the plan was. They were talking about from November till June. I think probably they might wind it up till March. So some bit pressure on bond yields, but I think the short end is something which will see more sell-off.
Before we get on to the India perspective, I also want to ask you what your perspective is on monetary policy here in India. But before we get to that, Devang, I think if you can, I'd like you to explain to my viewers who are tuning in what the correlation is between US bond yields and the yields here in India, or maybe in emerging markets. How does that affect us? If bond yields move up in the US, how does that trickle down to us?
Sure. See, I think there's generally this fear which goes across is on both aspects, which is bond yields as well as currency. Generally, strengthening of the dollar leads to the pair currency, which is in our case INR, leads to weakening of INR, and somewhere down the line, the worry is that once the rates also start going up and the US growth aspect or the prospect starts looking better, you might see a lot of flow going out from Indian markets to global markets. So that leads to weakening of currency as well as bond yields going up. That's the general thought process, or the general, I would say, consensus thought which goes around whenever you start seeing US rates inching up. And that is not only stands true for India, stands true for various other markets. Our view at this point of time is two things. One is our markets are not as dependent on, and specifically the fixed income market I'm talking about. We don't have a lot of global presence. Our penetration is very weak. I think somewhere down the line we are still talking about those inclusion of into global bond indices. So as of now, also if I look across, first of all, we have had a decent amount of global investors selling in the last 1 year. We don't see any immediate pain on account of increase in global bond yields on local markets. I think it will be the factors which will impact Indian markets. 20-30% of the reason for the yields inching up can be global reasons, but the 70% of the reasons will be local. What we need to focus on is the local growth and the local inflation and the macro environment in India and the pace of RBI reversal, which will lead to the direction of interest rates in India rather than too much focusing on the global bond yields. Yes, it will lead to some bit of volatility of 20, 30 basis over a medium term, but it doesn't lead to any directional sell-off in India. Lastly, to give comfort to all the investors and the people who are viewing, I think the RBI has done a wonderful job over the last 3-4 years on building up a huge chest of FX reserves. Okay, and that is somewhere down the line. I think we are the one of the currencies which have performed massively good. I think strong growth aspects, FPI flows in India, both on equity and other investments. That has led to a significant inflow of FPI and specifically dollars in our markets. So we don't see too much of a worry on account of this rise in interest rates in global markets. It is somewhere down the line, to a certain extent, believe that this easy monetary accommodative policy will stop, and somewhere down the line, rates will inch up. The short end of the curve in India as well as globally will see some pain. The long bonds are already pricing in a lot of, I would say, sell-off thanks to local factors, as well as globally also yields are pricing in. In fact, in US also people are pricing in the CPI to be at around 6% for the year. So we do not be too worried about it. Some mild jerk, a knee-jerk reaction here and there.
Okay. Now, I also want to get into, Devang, eventually how you see the yield curve moving. You've talked about possible flattening. We'll get to that. But to set the context, perhaps we should start with the latest macro data that you have looked at and what you anticipate in the Monetary Policy Committee meeting next week. We are going to talk after that as well. But just to set the context, you've seen a GDP print. You've seen tax mop-up data, you've seen the retail inflation print. How do you put all of this together and what context are you drawing from that?
Okay. So I say the local macro environment is quite positive. So if you look across on all aspects, as you rightly highlighted, I think the one thing which we also missed across is the festive season. The festive season has been very good. So if you look across at the various sectors, the retail trade, the consumer demand is back on track. If you add the element of GST collections, I think it is wonderful. So the demand cycle is looking good. It doesn't seem to be like a pent up demand. It seems to be somewhere where people have started consuming. We are back to pre-COVID in most of the sectors. So our understanding on the growth is that they are quite comfortable with the near-term as well as the medium-term growth trajectory. As you rightly highlighted on the CPI aspect also. So CPI, we believe so that the worry is threefold. One is food inflation has bottomed out not only in India, I would say somewhere down the line globally also, and which probably was the buffer which central bankers were holding, that if food inflation globally is lower, we should have, at least in India, where food inflation has a higher rate, we can manage the inflation well. Food inflation has bottomed out. We've started seeing tariff hikes by telecom players, which also play a major role in service inflation. We've looked at commodity and core inflation, which is inching up. There is the change in revision on GST rates in certain items. All this will add up to the headline inflation as well as to the core inflation. So looking at the pure macro, what we believe so is RBI is already on the path of removing the accommodation. You have seen that RBI has moved the liquidity from 8 to 10 lakh crores positive now to approximately 1 to 2 lakh crores. They have withdrawn it through a series of variable reverse repo rate auctions of 14, 28 days. And our belief is that the next path will be towards neutralizing and moving towards a normal stance on policy, as well as moving the corridor slowly and steadily from the 335 4% or today, which is 65 basis gap between the repo and reverse repo, slowly to move towards a 25 basis. How will I place the odds on reverse repo rate hikes in the December policy? Our view is that somewhere down the line, we might see 20 to 25 basis of reverse repo rate hike in the December policy, moving from 335 to 360. In a phased manner, move to 375 by February. And start looking at, depending on the macro environment as well as the inflation, if we don't see any major hiccups in the growth cycle, as well as we don't see any kind of major issues on account of this new variant on COVID, I think we should start looking at repo rate hikes from the April policy. So that's our view on the monetary policy, depending on the local macro currently. The new variant, there is a lot of noise around it, and that might provide. Sorry.
Sorry, no, sorry. You were saying about the new variant. Unfortunately, Devang, we're running out of time, and I also wanted you to tell our viewers what you think the strategy should be, considering that there is likely to be a flattening of the curve, like you suggested. Bond yields moving upwards, the basic trend expected to be that. Would you say that it makes more sense to position oneself in the shorter end of the spectrum or shorter end of the curve in the near to medium term?
Sure. So, as I rightly said, that the only risk to the view is the new variant and probable impact if we see a lockdown, something like that. Otherwise, I think that the path for RBI is to start increasing rates. Coming to the last bit of your question, where what should an investor do at this point of time? I agree with you completely. Our view is that the curve will flatten. Not only India, I think globally, we will see the curve flattening theme. It has already started to flatten. It will flatten more. At this point of time, what an investor should do, investors should continue to be at the lower end of the duration spectrum, stay invested into ultra short term floating rate strategies, which are using the curve flattening theme or using floating rate instruments to provide a hedge against the rising interest rate environment. Secondly, pro growth always works good for the credit cycle, and hence investors who are informed and who understand credit strategies which are invested more in AA. I think credit strategies also makes a lot of sense at this point of time. So stay lower duration, short end of the curve, and you can add floating rate funds as well as credit strategies to your portfolio for the next 12 to 18 months.
Devang, thank you so much for this conversation. In fact, and sorry for having interrupted you. Unfortunately, we were running out of time, but it's still been a very, very insightful conversation. I look forward to speaking to you in the very near future.
Thanks, Alex.
All right. Now,